Most founders think that the raise is the finish line. They imagine a wire transfer hitting their account and assume that the hard part is over. But the truth is this: once you raise capital, the real work begins. The raise is not the victory. It is the start of a new regulatory, financial, and operational standard. Today, we're going to break down the compliance requirements after a capital raise, differences between Reg D, Reg CF, Reg A, and IPO reporting obligations, what investor relations actually involves, why transparency is the foundation of investor trust, what companies must track and document, and how to maintain credibility in private and public markets. If you understand this episode, you will know exactly what the SEC, investors, and markets expect from serious companies after a raise. Let's start with an obvious but often ignored truth. When you take money from investors, you take on a responsibility. Responsibility to report, responsibility to communicate, responsibility to allocate capital properly, and responsibility to maintain accurate records. Raising capital is a privilege, not an entitlement. Reg D has the fewest ongoing reporting obligations, but most companies are still expected to maintain accurate financial records, proper investor documentation, compliance with offering terms, cap table management, timely updates for material changes. While there are no formal annual reporting requirements, sophisticated investors expect periodic updates. Private placements rely heavily on trust. Transparency keeps investors confident, especially if you plan future rounds. Regulation CF has formal reporting obligations. Companies must file a Form CAR, which is an annual report due within 120 days after the fiscal year end. It includes updated financial statements, management discussions, business updates, and shareholder information. Failing to file an annual report disqualifies the company from future Reg CF raises. A Form CU, progress updates, are filed to report milestones in the raise. A Form CTR, termination of reporting, is filed if a company becomes eligible to stop reporting. Reg CF investors expect communication and updates, especially since many are retail investors new to private markets. Reg A comes with much heavier reporting obligations. Tier 1 requires final report only. Tier 2 issuers must file a Form 1K, a Form 1S, Form 1U, Form 1Z. This level of reporting is similar to public company expectations, and many Reg A issuers treat investor relations with the same seriousness. Reg A builds investor trust by demonstrating transparency and governance discipline. Public companies, the full reporting burden. Once a company enters the public markets, OTC, NASDAQ, or the New York Stock Exchange, reporting obligations increase significantly. Public companies must file a 10K, which is an annual report, 10Q quarterly, 8K a current report, proxy statements, insider filings, disclosures on related party transactions, audited financials under PCAOB standards. They must also maintain independent board committees, internal controls, investor relations functions, regular press releases for material events. Public markets demand discipline. Companies that fail to meet standards quickly lose investor trust. Investor relations is not marketing. It is the structured communication between a company and its shareholders. Good investor relations includes quarterly updates, clear reporting, honest assessment of risk, transparency about challenges, milestone tracking, financial projections when appropriate, accessibility for investor questions, maintaining an accurate and updated cap table. The goal is simple: maintain investor confidence by communicating clearly and consistently. Investors forgive slow quarters, but they do not forgive silence. Lack of transparency leads to suspicion, loss of trust, difficulty raising additional money, board pressure, potential legal exposure. Investors understand that businesses face challenges. What they cannot tolerate is being left in the dark. Transparency is not just good ethics, it's good business. After a capital raise, companies must maintain accurate financial records, spend tracking by use of funds proceeds category, updated cap table reflecting all new shareholders, investor contact information, compliance calendars, board minutes, updates on material business events, documentation for major decisions. In many cases, third-party administrators or transfer agents help manage shareholder records, especially in Reg A and public companies. Let's talk about cap table management. A capitalization table tracks shareholders, share classes, percentage ownership, conversion rights, preferred rights, warrants, and options. Errors in cap table cause major legal and financial issues during due diligence. For companies planning future raises or exits, accurate cap table management is non-negotiable. All companies, even private ones raising through exemptions, must disclose material events. Material events include CEO resignation, major lawsuits, significant financial changes, failure to meet obligations, changes in capital structure, large acquisitions, or bankruptcy. Public companies disclose through 8K filings. Reg A issuers disclose through Forms 1U. Reg CF issuers disclose through portal updates. Failing to disclose material events exposes companies to regulatory and legal consequences. Investors fund companies that demonstrate accurate reporting, professional communication, consistent execution, clear strategy, proper capital allocation. The companies that secure multiple rounds of funding are not necessarily the ones with the best ideas. They're the ones with the best discipline. Capital flows towards predictability. The key takeaway: raising capital is not the end. It is the beginning of a new chapter, one that requires structure, compliance, communication, and accountability. Companies that master post-raise discipline earn investor trust, grow sustainably, and position themselves for long-term success.